Welcome, everyone. We're going to give it a few seconds for everyone to get logged on, and then we'll get it kicked off. Welcome, everyone. We're going to get started on the Ask the Experts webinar and the topic of optimizing systems for a successful 606 adoption. A few key reminders as we get started on this webinar is we have these series every 2 weeks. You can look at our past webinars and see recordings, and also sign up for upcoming webinars that we talk about a different topic each time. As a reminder, you do get CPE credit for this webinar. However, you must answer the 4 polling questions. If you have questions during the topic, feel free to ask them in the Q&A option in the Zoom meeting. We'll either address those through the conversation or towards the end, we'll address those specific questions and provide an answer back. After this webinar, you will get an evaluation form and the CPE certificate. You can see the on-demand video. You'll have a link to a future mailing list and an opportunity to watch more of our webinars. So thank you for attending, and we'll get started. My name is Brent Fisher. I will be hosting as a moderator today. With our topic of optimizing systems, we see companies preparing to adopt ASC 606, and there's many things to consider from a systems perspective. Whether your current way you're managing revenue is scalable to your ERP system. Can it handle some of the changes that will need to take place in order to manage the new rules and regulations? And the panelists that we have today have a lot of experience in seeing what companies and what our clients have struggled with or challenges as we assessed the 606 adoption and the web and their systems. We'll also look at how an ERP system like NetSuite handles certain requirements for 606 adoption. Chuck will be providing some examples of how ERP systems like NetSuite can handle those changes and how we've implemented them with some of our clients. So like I said, my name is Brent Fisher. I've spent 15 years working with customers, advising them on how to leverage technology, whether it's from an ERP, CRM, data analytics perspective. Have a lot of experience with companies going to a subscription model and actually build products on top of ERP systems to help support the changes with the new regulations. That's me, and I'll pass it over to Mark Jistel to introduce himself.
Thanks, Brent. Mark Jistel. I'm a director here at Riveron in Dallas. I spend my time focusing on accounting advisory work, assisting clients with technical accounting issues, capital market considerations, financial reporting, purchase accounting, as well as assessments and implementations of ASC 606. I usually work directly with client personnel, mostly CFOs, CAOs, controllers, both in the private and public space, as well as in a variety of industries. I'm responsible for overseeing delivery projects and working closely with client management to complete project initiatives. In addition, I serve as a 606 subject matter expert at Riveron, developing project methodology, go-to-market strategies, internal training, as well as assessment tools and publications. So with that, I think kick it over to Chuck.
Yeah, Thanks, Mark. And I'm Chuck Bunting at NetSuite, so I'm a principal sales consultant, but really what that means is my background is accounting focused, so I'm still a licensed CPA. I've been a controller and a director of accounting at both public and private companies, and I've done 2 NetSuite implementations. So I tend to leverage my experience both with NetSuite and my audit and accounting background to work with customers and really design a methodology for how to implement 606 within the system, whether that's managing things like fair value pricing or standalone selling pricing, as well as even keeping dual reporting in dual books. And that's really my role.
Great. Thank you, Chuck. Thank you, Mark. We'll get started with our first polling question to start our presentation. So, what progress has your company made in adopting ASC 606? In the Zoom meeting, you can answer this question. It looks like as the answers are coming in, pretty spread evenly, around have not started or done an initial assessment or maybe in the process of that. So thank you for answering those questions. Mark, I'll turn it over to you to start talking through, our overview here.
All right. Thanks, Brent. So how did this all start from a timeline perspective? In May 2014, the FASB issued revenue from contracts with customers. This is topic ASC 606. The new guidance was effective as of January 1st, 2018 for all public entities with calendar year ends. Early adoption was permitted as of the original effective date. For all non-public entities, they're required to adopt as of January 1st, 2019, with reporting under the new standard to be included in their December 31st, 2019 annual financial statements. The new standard established a framework for businesses to recognize revenue more consistently. The standard is complex and represents a fundamental and significant change in accounting and replaces all current revenue recognition guidance, including all industry-specific guidance. Compliance with the new standard for some companies involve a complete overhaul of systems, processes, and controls across many departments. We will cover the two transition methods here in a couple of slides. But in looking at the timeline, the key takeaway here is that revenue recognition for private companies is here. This places an importance on assessing your current revenue population now and determining any gap changes, which is crucial in determining the level of effort that is needed for implementation, and whether using an existing or new software system solution is needed. Not only will the implementation cause companies to make changes in the way that they do things from a system standpoint, it will also affect auditing, internal procedures, and controls. So the next slide, this takes us into some general statistics, which are always moving, but this data set provided by a 2018 EY revenue recognition survey is still a fairly accurate picture of where companies are at today. Specifically, on the public slide, the survey mentions that 71% of organizations have made changes to their revenue recognition disclosures since first reporting under the new standard, as compared to 29% who have not. Likely, those companies have seen changes to the evolving interpretations of the new revenue standard, which many of these interpretations are more applicable to some companies than to others. In addition, some of these public companies transitioned from a manual 606 adjustment in Excel to a more robust system to accurately reflect data, budget, and disclosures. As these companies have better access to data for which they can comply and confidently detail out fully in their disclosures. Looking at the private company graphic, you can see that private companies still have plenty of work to do, with only 26% in the solution implementation stage. Many private companies are still designing solutions. such as establishing IT systems or business process requirements, while the other 27% are still in the assessment stage. The key takeaway from this survey is that a lot of public companies are transitioning short-term manual workarounds to long-term technology solutions and adapting programs to reflect comments received from regulators, auditors, and other stakeholders. This means significant work is still ahead. It's likely that private companies are also dealing with many of the same issues, so taking a strategic approach on assessment and choosing the right system early, these companies can actually drive improvements across the systems, processes, controls, and operating models. So just to cover some more terminology, as I mentioned in the timeline slide, the transition alternatives that an entity must choose between when applying the new guidance include the full retrospective transition method and the modified retrospective transition method. These two methods are key starting points, and picking one that is fit for the business with the least amount of disruption will take time and analysis before ultimately making a decision. The full retrospective transition method. This method applies to the standard retrospectively to each prior reporting period presented in the financial statements. Assuming a calendar year a private company adopts for the audited period December 31st, 2019, the new standard is applied retrospectively to each prior reporting period presented with the cumulative effect of the change recorded in retained earnings, likely as of January 1st, 2018. Although this method is the easiest to understand, conceptually, it provides the users of the financial statements practical trend information, consistency, and comparability. But it is the hardest method to implement based on experience. This involves restating your financial statements with additional contracts reviewed in the previous periods. Now, if you're a new company, let's say 2 to 3 years old, and haven't done a deep RevRec scrub or been audited, this could be the method you choose. But what we have seen in practice and looking back at some of the early adopters, many companies started with the full retrospective method and then changed as they discovered significant time and level of effort. The next method is the modified retrospective transition method. This method applies the standard in the year of the initial application, and the company does not restate comparative periods. Instead, it recognizes the cumulative effect of adopting ASC 606 with an adjustment to the beginning retained earnings. So assuming a calendar year end a private company adopts for the audited period December 31st, 2019, the new standard recognizes the cumulative effect of the change recorded in retained earnings as of January 1st, 2019. So under this method, in the year of adoption, companies must disclose the amount by which each financial statement line item was effective as a result of applying the new standard and an explanation of significant changes. This results in essentially the requirement to maintain 2 separate accounting books. In addition, as prior periods will continue to be presented under legacy GAAP, there will be a lack of financial statement comparability. We have seen a higher trend of companies utilizing this method and would estimate in practice that roughly 75% of companies use the modified transition method over full retrospective. As discussed, both adoption methods have their advantages and disadvantages. Companies must carefully evaluate which adoption method is most appropriate, including consideration of both internal and external requirements, specifically if the change is significant enough to utilize a software solution. So this brings us to our last slide of discussing the 5-step model. So taking a quick look at the 5 steps here, the RevRec standard has a lot of gray area, but one thing that is consistent are these 5 steps. Step 1, contract contains a promise or promises to transfer goods or services to a customer. Step 2, a performance obligation is a promise or a group of promises that is distinct, as defined in the revenue standard. Identifying performance obligations can be relatively straightforward, such as an electronics store promise to provide a television, but it can also be more complex, such as a contract to provide a new computer system with a 3-year software license, a right to upgrade, and technical support. Entities must determine whether to account for performance obligations separately or as a group. Step 3, the transaction price is the amount of consideration an entity expects to be entitled to from a customer in exchange for providing the goods or services. A number of factors should be considered to determine the transaction price, including whether there is variable consideration, significant financing component, non-cash consideration, or amounts payable to the customer. Some of the variable considerations identified could be right of returns, early payment discounts, and future product offerings. Step 4, the transaction price is allocated to the separate performance obligations in the contract based on relative standalone selling prices. Determining the relative standalone selling price can be challenging when goods or services are not sold on a standalone basis. The revenue standard sets out several methods that can be used to estimate a standalone selling price when one is not directly observable. Allocating discounts and variable consideration must also be considered. Last step 5, revenue is recognized when or as the performance obligations are satisfied. The revenue standard provides guidance to help determine if a performance obligation is satisfied at a point in time or over time. When a performance obligation is satisfied over time, the related revenue is also recognized over time. So quick example, one of the biggest changes is in the software industry is the elimination of the requirement to establish VSOE of the fair value. Eliminating VSOE in some ways simplifies the estimation process, which will impact all undelivered elements in a software contract. For companies that are currently unable to establish VSOE for undelivered elements, the implementation of 606 will accelerate revenue recognition. Really, the goal of the new standard is to make a more consistent application of the standalone selling price guidance across all industries. Chances are many software companies will need to at least slightly change their RevRec process, while others may have more drastic changes. Another challenge of the new guidance is the requirement to track and manage the old method and the new method simultaneously if changes are required between the transition of the standards, so that you can provide comparative information if required to do so by the auditors. In all of these cases, RevRec software solutions such as NetSuite have built out the functionality to allow for both standards and reporting on both as well. I think Chuck will go into more detail and explain from the system perspective here shortly.
All right, we have a second polling question. So after Mark has explained some of the different transition methods, what transition method under 606 does your company plan on choosing? Modified, full, still assessing, or unsure? Give it a second for people to answer. Looks like the majority, 64% are choosing modified retrospective, with the rest still assessing or unsure. Okay, we'll close that question. Modified was the majority, and the rest still kind of assessing or still unsure what transition method. Also, to go to another question before we hand it to Chuck, and this is reflective of your current systems in place. So does your company's current ERP system or systems able to fully support 606 adoption? Pretty spread across all answers here, whether it's unknown. Some are choosing that they don't know if it'll be managed in an ERP system or it's not currently desired to be implemented inside of an ERP system. So we'll let that stay up for a few more seconds, and then we'll close that polling question. Okay. Chuck, we'll pass it to you. So as Mark kind of described the five-step method and the different components, how is a system like NetSuite, tracking the ability to manage those changes, and let you describe what you're seeing as clients come to you, your experience in the field, but also, from a product perspective, how do you see products in the market handling this change?
Yeah, definitely. So, my goal today is to give kind of a high-level overview of how NetSuite addresses that. So if I'm looking, at this slide and I'm kind of going left to right, NetSuite has this concept of a revenue arrangement. So what typically happens is you'll have a contract or a sales order within NetSuite, and billing will be completely independent from a revenue arrangement. So if we, let's say, sold a SaaS license with training and support, the billing intervals might be, upfront for all of that, or maybe in arrears. But the revenue arrangement, the goal is to decouple how revenue is going to get first, let's say, allocated and recognized from how a bill happens. So that's important if you might have revenue recognition for a 12-month contract, let's say starting in January, but your billing might be at the end of the quarter. We still want to be able to recognize revenue and use the NetSuite engine to do that, regardless of when that bill happens. But under the revenue arrangement, we break up the different, let's call them deliverables or elements. So back to the example I was giving, we, again, might have a SaaS license, maybe there's training and support, or even, a future material right that we have to deliver to a customer. And so those elements will get broken out automatically once that sales order is approved, and that kicks off the revenue arrangement. Then what happens is now all of those components are separately listed out within NetSuite. And so we create both a forecast and an actual plan. So a good example of that might be we've got professional services, and we're estimating that maybe it's a milestone that it's going to take 3 months to complete. So that would be a forecast plan to say, okay, every time we deliver a milestone, it's going to be 3 months from the contract date. Reality sets in, and maybe that revenue got accelerated or pushed out. And so we'll always be able to have a comparable of forecast to actuals within the system. Right in the middle of the screen, the revenue triggers. So this can be anything from a very simple contract where we start revenue day one of the contract and just recognize it, let's say, exact days or even period over the contract period. Or based on how we set up that element or the products that we're selling, it could be a fulfillment step, it could be a milestone, percentage of completion, but those different triggers can be unique, specific to those revenue elements. So once they're fulfilled, or if it's a simpler example where it's just we're going to recognize it evenly over the contract period, NetSuite automates creating those journal entries. What also happens is part of NetSuite is you'll have a deferred revenue waterfall, which is great for looking at anything billed and how we're going to recognize the revenue on billed amounts. And this obviously should tie back to your balance sheet. What we want to avoid, though, is having to gross up our financials and putting in full contract values when we haven't actually billed the customer. I've worked with the Big Four on quite a number of occasions, and that's one of the key things they always address. So NetSuite also has an independent report called the revenue forecast, which is kind of on that bottom left side. That's really your forecast for revenue as well as your tie out to the income statement. Next slide, please. So what also has been coming up, at least with the customers I work with, is the idea of merging different revenue arrangements. So commonly, let's say again, you sell your products or a SaaS license in January. A couple months later, you do an upsell, maybe you put in additional services, whatever it might be. And so what happens is, the Big Four has kind of stepped back and said, well, we really want to treat that as one arrangement, so to speak. Even though they were sold at different times, we need to basically treat them as one. So what NetSuite has the ability to do is say, okay, I can look at those two different, let's say, contracts or sales orders, and I can merge the revenue arrangements underneath those. And really what happens from a NetSuite perspective is if you've recognized revenue, let's say January, February, and March, you've locked down the periods. Obviously, we don't want to have to, reopen periods, and we don't want to touch prior financials. So once that merge happens, and it's just kind of a point and click, way to do that, or we have customers that even want that automated. Let's say it's a customer within the same quarter, and they don't even want to have to make the selection. But we will reallocate what's left between those two arrangements, one being the original, let's say two being the upsell, and then recognize that new amount using a different allocation going forward. Next slide, please. And so this is a common thing that I get asked a lot about with prospects, and they say, do you have the ability for dual reporting? And the answer is yes. So within NetSuite, it's actually just a core function with the system. It does take, obviously, some implementation work, but whether you call it dual reporting, at NetSuite we call it multi-book. Really what it's designed to do is take one sales order, and I'm using the term sales order synonymous with a contract just to keep it simple, is we only want to enter that sales order once, and we only want to obviously invoice for it once. We don't want to have to invoice in two separate sets of books. But that transaction, that revenue arrangement, actually can have two completely different revenue recognition methods. So, for example, if we have under our old, let's call it ASC 605 books, a SaaS license where we're just taking it ratably over time, and we obviously have a forecast for how that's going to look, that would be book one. With ASC 606 books, we might have a completely different method for that same transaction. Maybe we're pulling up some of the revenue dollars for that license more up front, and maybe we're carving out or allocating revenue to something like professional services or training. So it could be a very different type of allocation. So the second set of books will keep its own revenue arrangement to keep the two independent. And then everything that you would expect, right, in terms of being able to forecast under both old and new methods becomes key. So in theory, you could use multi-book for either the modified or the full method. I've seen some customers that have adopted the full method, and they still want to run for really managerial or, let's say, board reporting dual books to basically say, here was the old impact versus the new. Where other customers I've worked with under the modified approach say, well, if we can run dual books, that'll help us get to that retained earnings adjustment, and then we'll, again, still have that kind of comparability. So, and with multi-book too, the byproduct of this is it's also designed for things like, let's say you have GAAP versus IFRS differences, or you have statutory differences. So multi-book's been, core in NetSuite for, I believe, over 5 or 7 years. But when the new accounting standards came out, this was a great sort of byproduct that we've been using to help customers leverage. Next slide, please.
Great. This leads us to our fourth polling question. And it is, does your company have the bandwidth to support 606 adoption, or will your company need external expertise? We'll launch this and give you a few minutes to answer. as the votes are coming in, it looks like, again, there's some need help, some are unsure, and some believe they have the proper resources and technical expertise in-house and ready. Give it a few seconds, and then we'll close that polling question. And then we'll go on into more of the question and answer panel discussion phase of the webinar. So let's close that polling question, and we'll start with a panel discussion around, these are questions that have come up with our clients or that we've seen in the field as we've gone through either system implementations or companies looking at the changes that need to be made. The first question I'll start with Chuck is, as you were describing how NetSuite handles certain aspects. Obviously, you talked to several clients out there that are evaluating new systems. What do you see clients using for this approach right now, or what systems might they be coming off of?
Yeah, QuickBooks is always, one of our, I don't want to say competitors, but it's the primary system most people are migrating off of. And QuickBooks does not really have a concept of revenue management. So what a lot of customers are doing, right, is managing these things in Excel to do not only, allocations or tracking things like SSP, but every single customer, and I just kind of speak from my own experience of using QuickBooks, but trying to manage, a pre-IPO company, is you'll have an Excel workbook for all of your customers. So now with the burden of, 606, now you're actually duplicating those Excel workbooks offline. That seems to be a common, challenge that we address kind of instantaneously through the architecture of NetSuite. Other systems, I won't pick on, but that are looking to manage standalone selling price a little bit more dynamically, meaning maybe you sell the same products to your customers, but your auditors said, well, for customer A, it's actually a different standalone selling price from customer B, even though, at face value, they look identical. The way NetSuite manages, standalone selling price without having to duplicate items seems to get people really excited that they can, have a dynamic calculation depending on the subsidiary or the customer or the location they're selling to.
Great. Thank you, Chuck. Mark, I'll ask a similar question. In your experience, what do you see clients using maybe as a ERP system or a tool, managing this change?
Yeah, so a lot of the clients that we see from the assessment phase, like Chuck was mentioning, is a lot of Excel documents. So as they're transitioning, whether it's using their internal system or choosing NetSuite or choosing some other model, I think the evaluation on the assessment side is so key, just to ensure that we've identified the gap analysis and we know what our differences and impact is going to be, and that will kind of set up how much level of effort it's going to be from the system side.
So Mark, follow on to that question, as you're doing the assessment and gap analysis, how at Riveron are we looking at the impact to systems, and how do you evaluate that?
So I think it's just looking through what kind of data points, going through kind of a checklist of what changes the company wants to see. Do they want the budgeting tool? Do they want, detailed disclosures? Going through a high-level checklist of what they want in the future state, and then obviously planning ahead and making sure that the data migration efforts are in place to properly reflect, existing and new contracts, so that the data is consistent.
Got it. Chuck, question for you. When you're talking to prospects or clients, are they evaluating, are they talking about the modified perspective versus the full approach? And what advice are you giving those clients?
Yeah, and if they haven't chosen a method yet, then I kind of pause with them and say, okay, to Mark's point, that's key. Where it becomes important is, and I've had a few customers that have almost changed mid implementation, is let's say you're doing the modified approach and the impact is not super significant or material, so we're going to keep an Excel sheet for sort of the old 605 and then implement, let's say, open contracts going forward into NetSuite under 606. And that's a very, very common scenario. But if then you're mid-implementation and say, okay, we're going to change the full method, now what you've done is you've sort of opened up 2 or 3 years retrospectively or retroactively, and now you've got to put in all those transactions one by one into NetSuite so that we can do the proper calculations. So I really try to make sure that, with the customers I work with, we have a game plan. On the NetSuite side, we're very experienced with implementing both, but we want to have that clear plan so that the implementation is successful.
Great, thank you, Chuck. And I'll just remind the audience as we're going through some of these common questions that we've seen, and just discussion points. If you have questions that you want answered from the panel here, feel free to type those in. Mark, back to you. I know you've been involved with several projects, and they actually have some changes to their ERP system, whether it's NetSuite or Oracle or Dynamics or some other solution. Can you share some examples what you've seen with clients and what they've had to do? Yeah.
So recently we had a public company that was under the consolidated holding company that was public. They, like we discussed before, were doing everything in Excel, and they basically thought the impact would be roughly $5 million, where they didn't review all the contracts. But going back through all their contracts, their filing was delayed for the 10K, where we had to go through about 200 manual contracts and reallocate the software license forward, where the impact was much more significant. This caused a lot of heartache, delays, material weaknesses, for which we had to kind of build out a plan to say, hey, this is all still in Excel. We need a solution to fix this. So they actually moved over to NetSuite, doing a full implementation within, as well as using the 606 ARM that Chuck was mentioning. So now we're still in the process of keeping everything in Excel now, but transitioning over in the next month or two. So it's been a 6-month process where we brought in our control guys as well as our technical accountants to write up the policy and align that policy with the business and ensure that there's a smooth implementation standpoint.
That's great. And Mark, have you ever been in a scenario where maybe they already have something deployed and they had to, the system just wasn't going to work and we had to re-implement or change systems? Have you seen that scenario?
Yeah, I think for some of the legacy public companies that we worked with, where we thought the initial software solution would be, viable, as changes have been made over the last couple of years, we've had to kind of rethink those and move away from what we thought would be, positive results from the legacy system. So I think evaluating those as revenues being recognized. So initially we thought this would be a great solution, but in practice with disclosures and changes that happen through these new contracts, we've ultimately decided that we need to reevaluate and move to a new solution.
Got it. Thanks. Chuck, as you've been a part of a couple of IPOs, but also you see a lot of clients in the market. What recommendations would you give of challenges that they should be aware of during the implementation?
Yeah, kind of in addition to obviously picking the method, sort of understanding if and what that impact is going to be, is it material or not? From my perspective too, I don't want to over-engineer or recommend anything if the impact isn't as critical. So anybody that can give me that starting point, we can have a better discussion. From a system standpoint, the challenge I see in a lot of cases is you might have, a separate CRM or even a separate billing or subscription tool. And so the challenge with bringing in a lot of different point solutions for NetSuite is we tend to only get invoice level detail, not the, let's say, underlying contract behind it. So it's always difficult to do rev rec on an entire contract, right, if you don't have the full contract to start with. So that's where I like to kind of have discussions of what are those point solutions that are going to stay, whether it's you're using a CRM tool like Salesforce, or are you using also a separate billing tool to manage subscriptions, and can that still stay in place, or should we think about bringing billing also into NetSuite and managing the contract end to end? Those tend to be the biggest discussions I'm coming across recently, as well as even looking for some of those more like outlier scenarios. So even managing like present value or of long-term contracts, or discounted payment terms, that can have an impact to revenue recognition. If you've got material rights, kind of those small nuances, the more that we know going into the implementation, the easier it is for us to set up. Not that it can't be done later. And then things like commission expense, that's obviously one of the main impacts of 606, in taking that expense over, let's say, either the life of the customer or the customer contract. So just having some of that information organized already really gives us a leg up.
Yeah, I think just to add on to that too is, you mentioned several different, systems or processes. And like one thing that you have to do when evaluating this change is also look at, what is the end-to-end process? What are the technologies that are involved? We've seen scenarios where, they have a very unique configure to order type of approach where they're bundling hardware and services into the subscription. This, high number of salespeople that are quoting in more of a CRM type environment. And then where does that contract live? Where do the data points live? Where does the billing occur? So we've seen, a full end-to-end solution may consist of a CRM system with an add-on to help with the revenue side, and then the billing, the final bill goes back into the ERP system and is just tracked from that standpoint. We've seen, where you start the quote inside of a CRM system, but then the quote, when it converts to an order or a contract, then goes to the ERP system. So that is the single source of truth for the contract. It sets up the revenue schedules, and the billing is done through that. So I think our advice to clients is really, let's look at the full process, because we have to look at the contract data points. Where are you storing the data? How are you billing? What does that revenue process look like? And what are all the systems that might be in place and integration points? And are you better served in kind of point solutions and integrated, or is it better served in, one system where you can take that kind of single system approach? And there's not a silver bullet answer. It really kind of talks through, what are the processes and the people involved in that. Mark, would you add on to anything kind of discussed there from, different systems that you're seeing, where they're storing the contract data as opposed to where the billing occurs? Any other examples that you could give?
Yeah, I think having those in one central location is beneficial. A lot of the clients in the assessment phase You know, contracts could be in a wide variety of places. So making sure that, you know, we can talk through those contracts and understand each of the components and how that's going to, you know, affect the rev rec standard, but also billing and compliance and operations within the organization.
Got it. And one follow-up question on the impact of the ASC 606 change, and how does it impact existing contracts and perhaps service agreements? Mark, do you want to take an initial response on that one?
Yeah. So I think obviously depending on the industry, but what we see, you know, for manufacturing that might be using completed contract method, you know, we might see accelerated revenue there as goods and service are delivered. So this is kind of switching from the completed contract methodology over to POC. Retail loyalty points, so loyalty points earned by program members will be valued using relative selling price instead of the incremental cost method. And big changes in the software industry, which we kind of touched on earlier, was licensing of IP. This is categorized as symbolic IP, will now be recognized over time. This change may result in acceleration or deferral of revenue depending on when the goods and services are transferred throughout that contract. We also have some variation between determining appropriate 606 treatment, whether goods and services have an alternative use and their legal right to compensation if a customer cancels a contract for convenience. So going back to the thought there that we need to make sure that we have all the organization involved, from, you know, sales to legal to accounting. I think there's a lot of changes depending on what industry you're in, but doing that initial assessment is key. That's
great. Why don't we move it to the Q&A session of the webinar, and I think we've got a couple of questions that have come in. So Mark, Chuck, I'll just kind of read them off and we can determine who best to answer the question. So one that came in here are, do you see customers using external auditors, consultants, or others to assist during this change in implementation? I could take that one. Yes, I think obviously Riveron, we've helped many companies with doing the technical accounting assessment work on the front end, as well as collaborating with our business process improvement group to implement systems and data migration. So initially doing the assessment is so key, just to, you know, interpret if there's any gap or changes that need to be in effect. But then two is just having a plan, which you mentioned, Brent, kind of an end-to-end plan with all key parties involved, just because if there's significant impact, you're going to be changing data and migration and operations. And obviously, on the external audit front, getting them involved early in the process, just making sure we're aligned on reports that need to be audited, and just kind of setting up controls that they'll ultimately audit for the year end. Got it. Another question that we had come in, or what are some of the risks we might face if we're not prepared? I'm assuming kind of risk that if they're not prepared for the change.
Yeah, I could start with this one.
Go ahead, Chuck.
Yeah, at least from a systems perspective, kind of I know, Brent, you probably touched on this already, but if you're looking at existing contracts and under the new method, maybe, you know, you have different standalone selling prices now. So a contract that used to be 1 or 2 items now could be something like 4. Really understanding the different deliverables in your contracts is key. because from a NetSuite perspective, we need to know what those are, even if those deliverables are not necessarily customer facing. Example is maybe you've embedded support and maintenance into a license, and a customer facing SKU just says the license. But knowing those different components is going to be key for us to be able to do that revenue recognition the right way. What we see a lot in a lot of cases is customers will do a scrub of first their product SKUs to get those down to a more manageable and realistic list, and not bring in sort of old data. And then they'll, after that, go through different contracts and say, yep, here are additional deliverables that we need to create within NetSuite to set up for revenue recognition. So if you've got an understanding of what those will be, then again, it just makes that implementation that much better. But if you're doing it on the fly, then it just obviously is going to push out that implementation time from having to set it up, tying out the revenue impact to what you would expect it to be.
And thanks, Chuck, and I can add on to that from kind of an accounting audit perspective. Just from what we've seen on other clients is compliance is kind of the biggest risk factor there. So delaying the filing or contributing to a material weakness that then you have to resolve by the next filing. So just not being compliant, which means doing a more thorough job on the front end to ensure that you can see the gap analysis and that you have coverage when you actually implement the new standard.
That's good. It ties into maybe another question, which is kind of interesting and hard to answer, but we can give some guidance. The question was, how much time and effort does it take to change accounting systems? I'll take a first pass on this, and really it depends. I mean, that's the best answer. It depends on a number of factors. What are you coming off of? What's the data migration strategy? How clean is your data? Are you looking for outside help to take on a bulk of that change? Do you have people, assigned internally that are going to be dedicated to this project? What system are you coming off of, and what system are you going to? All those can kind of play into, the time and effort. Additionally, is it just, the back office financials, or, what about the supply chain, the CRM aspects, HRIS? So you kind of want to take a holistic look of what is the reason you're changing and what are all the components. But, I would say, a middle market type size company, if they're looking at a financial system, it could be as quick as a couple of months to, maybe 6 months, depending on complexity and what you're trying to do. So it's really about being prepared, understanding the roles and responsibilities, understanding the requirements and what your desired business outcomes and what you're driving towards. Really, determine how much time and effort that you'll need for that. It looks like that is all the questions that have come in. So I think we'll start closing down the webinar. And I just want to thank you, Chuck, for being on here and giving your perspective on what you're seeing. Thank you, Mark, for just describing some experiences that you've had and giving us an overview of what to expect. And thank you for everyone that joined today. We hope that you find that valuable. And you'll get an email with a follow-up of the recording and an option to look at our future webcasts. Thank you for your time today, and have a great rest of your afternoon.